on Friday, that was a classic downside reversal, larger than average spread, closing at the lows, at new highs, all that. It was like it's textbook. So what you expect after that is further weakness. So with this morning's strength on a Monday, which I don't like Monday morning gap ups, at least it's a mild gap up. I would actually take this opportunity. If there was anything that you didn't sell on Friday, I would be looking to reduce that this morning during the strength, maybe putting on some hedges. I put some hedges on late Friday. And actually, after we did the SMT video, I added to the my hedges just because, it's just reminiscent of what happened in 03 and 09, where, we had kind of a nasty pullback after those downside reversals. But worst case scenario, let's just say for a hedge, worst case scenario, let's say we take out Friday's high, well, then you just remove the hedges. So that's how I'm looking at this. So I think you should be cautious here. In the very short term, the power trend is still on, but I think a pullback to the 21-day would be normal here, even underneath the 21-day could be in the cards. So that's just the lens I'm looking at the market at this moment, but I'll stay flexible.
So what would you say is the best way to hedge?
I'm doing SQQ. We're doing, which is a triple, which I don't think most people would want to do, either reducing your positions or, which is the simplest, that's the way Bill would do it. Or putting like just a short Qs, short SPY. You could do double inverse, single inverse, whatever feels comfortable to you. Never push it with a hedge. And you want, like I think Harold mentioned, you want to lose on your hedge. Like that's best case scenario.
Right.
And you don't have to hedge at all. This is just my take at this moment in time. And I could be wrong, but based on the evidence that we had from Friday and the 0309 that's been tracking, it's more in the cards than it's not.
Okay. So if you want to hedge your portfolio going with an SQQQ, that's the 3 times the Q.
And most people should not do a triple, like a double, like a QID.
QID. Yeah, that's the double.
And then like an SDS, which is a double of the inverse SPY. I think those are good ways of going, or you could just do like an SH, which is a single, the Sammy Hagar trade. And then what is it? PSQ or something?
Yeah.
Single Q.
Sounds right.
Yeah. So, or you could just not do any of those and just wait and let your stocks, just tighten up your stops on your stocks, your stop losses, and just, ignore what I'm saying, that there's nothing wrong with that either. I tend to be a little bit cautious. That's the way Bill was always wired. He was always like looking around the corner for the boogeyman. And that's kind of how I am too. So, for better or worse.
And then how much do you hedge? A half hedge, full hedge? How do you know how much to put on?
That's the question is really personal. It depends on how fast you're willing to take off that hedge. My hedge is pretty big right now. And so I don't want to say it because I don't want people to follow in along with me, but it depends on how much conviction you have and how quick you will remove it. I'm very fast with my own account. So that's why I don't talk about how deep I am in, because it'll be, too dramatic. So just take whatever you see on Swing Trader, that speed, and just multiply it out, because I'm quicker both in and in out. So it's just whatever's comfortable for you. Like that's more important than the right amount, because if you can handle the hedge the right way, meaning if you're wrong, actually be able to remove it. So if we go above Friday's high, you have to remove the hedge. And sometimes it'll just go above there and then roll, but you have to be aware that that is a scenario, as Justin always points out, like the different scenario analysis you do. Those are the head fakes at the highs are the worst. And then if it goes down, you want to be able to remove it as well. So like, let's say the Qs do come down to your 21-day. At that point, then you want to be reducing your hedge because of your potential of it just doing what's normal. Because that 50-day is way down there. We did test the 50-day back in 03, 09, or we got close to it. And so that big of a move down there would be a little bit extreme. So I think somewhere just underneath the 21-day would be the most logical test.
And Justin, something else that we talk about with hedging is, knowing what you're hedging. If your portfolio has more of a tech bent, then maybe something of, the QQQ. But if it's outside of tech, maybe something with SH is what I keep thinking of, but
Mm-hmm.
this, so
Yeah.
SPY. But to Harold's point, if I guess if you have chip exposure, maybe looking at something chip specific, with options. They even have inverse ETFs on individual stocks.
Right.
So
Mm-hmm.
you can get pretty specific. So what are some guidelines from you in terms of how to select that hedge? So that way you're doing your best to avoid losing on both ends, right?
Mm-hmm. Sometimes I think it's just a matter of really observing and looking and saying, okay, is this working the way that I would expect it to? And that's one of the reasons why I like Chris's hedging strategy for individual stocks, just using put options on the instrument itself. That's always going to be kind of your cleanest.
Mhm.
But then, and look, you still have kind of the, time value and all of those things that you have to deal with options. But, when you do start getting into other instruments, then you have to start thinking, okay, like in the example of the Qs, what if you have most of your stocks going down, but the mega caps are going up? That's one of those scenarios where you can lose on both sides, right? Because
Mm.
you have, you're positioned in a broader spectrum of tech, and so you're taking the hit in your portfolio, but at the same time, the Qs can be going strong because the mega caps are, looking okay, and they're propping up the index, even though most things are going down. And that's why we've been looking at like the RSP and things like that. So those are things to consider. And I mean, I think, sometimes the easiest thing to look at is, okay, is it going in the direction that I want it to? Is it providing me the protection that I want? Sometimes what you can do, I mean, there are actually, this is where we're kind of in such a great spot as investors. There are like tools that will kind of tell you, okay, hey, what is your correlation? There are things out there that you can like look into to see, okay, have I picked an instrument that is not correlated that much to the stocks that I own? But also, you've got to recognize that there's kind of what they call the correlation of crisis. So what can happen sometimes is the correlations are normally, one way, where things aren't correlated, like, oil is not correlated to tech, or all of these different things. But then when something bad happens or something really good, things tend to correlate closer to one. And so you do have to be kind of aware of when things are a little bit different than normal. So it really is just kind of a monitoring thing, and again, the best way to monitor, is to look at your own portfolio, because that is reflective of the decisions that you're making. And Bill O'Neill always called it the report card, right? You can't duck that report card. It is what it is, and you can't just say, oh, it's this person's fault, it's this person's fault, it's the market doing this. At the end of the day, the grade is the grade. If you're making money, or if you're losing money. And as Mike also said, the idea here is to hopefully lose money on the hedge, right? Have it be a bad trade. And if it is, then you're going to do that risk management on that trade, but overall your portfolio is going to be in a okay position. So it is that combination of monitoring, risk management, and some good decision making.
Harold, any hedging tips from you? Additional hedging tips from you right now?
Well, I'd say first off, if you have stocks that are maybe small gains, maybe just take those off and lock in that gain. Or same thing with the losses. You have something that's down, they'll keep that loss small and start paring down your portfolio. Then look at, okay, something like you already mentioned that the inverse ETFs. I tend to be heavy weighted overweighted towards technology. So it's somewhat easy to me. I use either SQQQ or the option strategy that Justin mentioned on individual stocks.
Mm-hmm. And then, Justin, something else that we talk about, if you're using an index ETF to hedge, instead of looking at the technicals on these inverse ETFs, you want to be looking at the underlying,
Yeah.
right? So instead of looking at SQQQ for your signals, we would be looking at QQQ, right?
Right. And it's, part of the reason is because the graphs can look so funny on some of these inverse or leveraged ETFs. They can just kind of vary, because remember, you're not always dealing with a perfect instrument. These are things that you're using derivatives in order to achieve the goal, and they're really good at doing that on a daily basis, but not so much on a long-term basis.
Right.
So if you're looking at a pattern in the Qs, oh, you know what, I'm bearish because I see a head and shoulders pattern, it might not always translate, as well. And again, when you look at some of the inverse ones, because of contango and how they go down over time as you roll those things, and the market tends to go up, you can just have a very funny looking chart. So yeah, I think it's a good idea to be using the underlying. If you're doing a hedge on the SPY, use that as your kind of instrument, whether you're doing SH or SDS or, what have you. Even on when you're going in the same direction, a lot of times we'll use SPY versus UPRO, let's say, which is the 3x leveraged bullish side. So it just kind of helps you, make sure you're kind of looking at a chart that is a little bit more normal, and not one that is, has its imperfections.
And folks want a listing of those tickers that we talked about. So I'm just going to pull up my recent symbols list. So we talked about SDS and SH. Those are the 1X S&P, right?
SH is the 1X.
Oh, okay. SDS is the 2.
Yes.
Okay. So SDS is the 2, and then the 3 is is there a 3?
Yeah, there is.
Is it PSQ?
That's the QQQ.
Oh no, that's the
yeah, that's on the
2X
Qs.
or 1X.
I know there is one.
There is
1X.
one. Yeah.
QID is the 2X, and then SQQQ is the 3X.
Is it SPXL? Is that?
Oh yeah. That sounds right. Or is that?
I don't know.
There's
the bullish
Oh, I'm sorry. Yeah.
SPX. There's SPXU.
Yeah,
which is
SPXU.
3 times.
Sorry. Yeah.
Right.
Or SPXS. Is that? Gosh, I'm sorry. You know what? I don't know that I've ever went 3X inverse on the S&P 500. I mean,
you SPXU for the
SPXU. Okay.
for
Yeah,
the-
you tell me
There's
you tell me
both.
Qs, and I know SQQQ off the top of
Yeah.
my head every day,
Right.
but it just escaped me. And I know I have a list somewhere of all of it for
And
the
and all of these
Qs,
things can be
IWMs.
Googled. very
Yeah, there
easily.
is that
So.
search engine that does a lot of this for you.
Yeah.
Let me
Yeah.
just say, if you've never traded a triple inverse or a triple leverage
careful.
in either direction instrument, I wouldn't start without studying how quick they move and everything. I think you're fine with a single or a double if you're new to the strategy. And remember, Bill wouldn't hedge; he would just reduce. So there was always
That was his hedge, cash, right?
cash was his hedge. So this is just different styles. So, and you want to be comfortable, and you've got to, if you are going to hedge, I cannot emphasize enough, you got to be willing to remove that hedge. If you're wrong, and like we keep saying, you want to lose on a hedge. So keep that in mind as well.
The other thing too to think about is, with all those disclaimers, to be careful in all of that and do your homework and, make sure you know what you're doing and how much of it you're doing and what it is that you're hedging is the timing, right? Because it's like, if you wait for a sharp break of the 21 day to put on the hedge, right? Then your timing is going to be off most likely. right,
Yeah.
guys?
Exactly.
Right.
Yeah. So basically you either hedge on like on a day like Friday or this morning, or at that point, if you wait, if you wait until you break the 21 day, it's not that it's wrong. It's just that your odds of it helping you are just different because at that point, you're hedging against something horrible. Right now, you're just hedging off for something that is normal, like a normal, shake out below the 21 day. And then what that does to our growth stocks ends up, hitting those a lot harder than what the market might be down 1%, but the typical growth stock is down 2, 3, or 4%, if not more during that same time frame. So it also depends on what's in your account, how volatile it is. And like Justin was talking about the correlation, like lots of times things aren't correlated until it gets really ugly. Then
Right.
everything is correlated. And we've seen that way too many times in life.
And that's why Bill was always of the mindset like, hey, this is why, market timing helps, because diversification doesn't really help you when things get bad, because
Right.
You think you're diversified. You're like, oh, I've got a little bit of this, I got a little bit of this, I get a little bit of this. But what happens when everything is getting hit? Everything is coming down. I mean, like, the financial crisis, we've been using, the 2009 as kind of a precedent, but the financial crisis, the correlations were so elevated
Yeah,
during
everything
that
was going
time,
down.
yeah, so it's really kind of important that you
Same thing in 2022.
yeah. Yeah.
Mhm.
Now you did have some things that remained uncorrelated, like energy was, doing very well in 2022. So you did have some things buck that trend. But when things get bad, they do tend to, correlate more.
Okay, the final thing to talk about for hedging, and I guess this also says something about where we are in the market if we're not just talking about, okay, this actionable stock, which, there might be some to consider today. Who knows? But clearly we're setting the tone of the show in the first 30 minutes here. But the final thing to cover with hedging is, how do you know when to take it off, Webby? So if we get that downside reversal buyback signal, so is that your stop, right? You kind of mentioned that, right? Using Friday's high as your.
That would be one stop. That would be a stop if you're wrong. The highs there. That's one thing. And then two, if things start firming up before more than you think, like let's say, not today, but because we did see in those examples, sometimes today you move, historically, sometimes you had some blue days on the day after the downside reversal or even right after that. So it's more what happens later in the week, or if you come down far enough and you have an upside reversal, that's where you want to remove it and actually go long with that low as your stop.